Good evening, everyone. It's a real pleasure to have all of you with us this evening. As a self introduction, since that's the only way to go, my name is Sunil Mehta. For some of you who do not know me, I am the Chairman and Managing Director of SPM Capital Advisors, Chairman of Yes Bank, and more importantly for this evening, a founding board member of the Asia Society India Center. The Asia Society has been exceptionally busy during this period of pandemic. Asia Society's programs across our 14 centers are now virtual and global. We have hosted more than 600 programs during this lockdown, including some very interesting discussions on the economy, food security, public health, and of course, world politics. They're all available on our YouTube page. So do go ahead and view these webinars whenever you have some time. Our discussion this evening on reforming and recovering Indian economy post the COVID-19 pandemic will look at the Indian economy way beyond what was earlier projected as an end date to the COVID-19, somewhere towards the latter part of this year, which now obviously is a shifting goalpost. During the midst of this pandemic, many economists, opinion makers, media anchors, and people who sort of understood India well had predicted that India is probably going to be one of the worst hit as far as this pandemic's impact on its economy is going to be as compared to some of the other world economies. There were various projections of the growth deacceleration, what impact it will have on the Indian economy across different sectors, and of course, the entire negative sentiment that it sort of brought in. And it really sort of, one wondered when the recovery will happen, whether it was going to be towards the second half of the following calendar year or towards the earlier part of 2022. But there were speculations rife in terms of how long this tunnel of pandemic is going to impact the Indian economy. Over the last several months, there have been, fortunately, some green shoots that has given us a sense of confidence that, and based on actual facts and figures, that indicate that this is perhaps not going to be as difficult as it was earlier projected. And we obviously will want to understand whether these green shoots are sustainable, whether whatever signs in terms of the numbers, the upliftment of the demand, the entire supply chain coming back into some degree of in a cohesive manner, India's position both domestically and globally, is there a new opportunity for India? And is India preparing itself adequately to be able to capitalize on this opportunity or deal with the unpredictability of what's going to happen if we have a second or a significant second or a third wave that is visible in some of the other economies and in India also more recently. We also have the Prime Minister's objective of creating India as a $5 trillion economy, the whole aspect of Atmanirbhar. How is this going to be delivered? Is this going to be delivered in the time frame that it is being indicated? And is the policy framework commensurate with whatever objectives we have laid out for ourselves? To discuss this, it's a privilege to have such a interesting panel this evening, and I couldn't have asked for a better composition. Economists, two serious economists. We have uh, one individual who is absolutely in the middle of the base industry as far as steel is concerned, which is an indicator of how production and manufacturing is taking place. And I couldn't have asked for a better person to moderate this panel this evening than somebody who's been at the helm of the media and been a very experienced media professional. Surjit Bhalla, an Indian economist who's currently the executive director for India at the International Monetary Fund. He is a former member of the Prime Minister Modi's Economic Advisory Council. Welcome, Surjit, and thank you for joining us from Washington this evening. Narendran is the CEO and Managing Director of Tata Steel Limited, an absolute industry expert, been really at the helm at CII also. Narendran has over 32 years of experience in the mining and metals industry. Ridham Desai is the Managing Director at Morgan Stanley and heads their Indian equity research practice, one of the top-ranked equity teams in the country. And finally, Menaka Doshi. She also needs no introduction. We haven't seen her on the electronic media in recent years, but she's been busy making a big platform of hers as the Managing Director at Bloomberg Quint, India's leading multimedia business news platform. Welcome, all of you. And welcome to all our participants this evening. A bit of housekeeping for everybody before we proceed. All those who are joining us on Zoom, please leave your questions in the Q&A box and not the chat box. For our audience on Facebook, please drop them in the comments section. I would now like to invite Menaka to commence the discussion. Thank you.
Sunil, thank you very much. Sorry, I'd left my mic switched off because that's the fundamental rule of webinars. So thank you very much for the generous introduction. I'm delighted as well to be able to put my questions to the esteemed panelists this evening. And with your permission, I will include you in some of my questioning as well, because you have a ear to the ground when it comes to the credit growth environment. So welcome to everybody here at Asia Society. Sunil's already laid out the backdrop of this discussion. So I'll keep my introduction very, very quick and brief. We've had a very difficult year, to put it mildly, but let's start with the good news, or the more encouraging news, if I can put it that way. Most recent data has prompted upward revisions in India's GDP forecast. So now most experts, economists, research houses expect a 10%, give or take, 100 basis points contraction for the fiscal versus the 12, 13, 14% contraction that we were discussing several months ago. Yet, on a score of other indicators, whether it's unemployment or investment or credit growth, obviously the situation has deteriorated substantially further this year. Now, some may argue that RBI or the monetary policy aspect has done what it could, and there's very little fiscal capacity to do anything substantial, definitely not this year, beyond what has already been announced. Hence, the broad consensus seems to be that even if we end this fiscal a tad less injured than we had originally anticipated, the recovery for India's economic growth will take several years, lowering trend growth. So just to give you one example or one view with regards to trend growth, Priyanka Kishore of Oxford Economics says that she expects India's growth equilibrium to worsen substantially over the medium term, with potential growth averaging just about 4.5% between the years 2020 to 2025 versus their earlier forecast or expectation of 6.5%. So that's a 200 basis point cut. Now, in the light of this, here are the three themes I'm going to discuss with my guests this evening. What data points are they looking at to gauge the strength of the recovery this fiscal? So that's the near-term question. The data is very noisy, so I'm hoping they will guide us on how they're reading it. The second, has the government's response been, as some put it, incremental and weak, or as others this year, whether it's farm or it's labor, are they enough to lift trend growth substantially? So let me start first with Dr. Bhalla. And I think that the data point I'd like to put to him is by far the most critical issue this economy faces, and that's of jobs or unemployment. Dr. Bhalla, you know the data already, so I don't need to repeat it for you. But nonetheless, if I can just put some numbers out there for our audience, I think CMI has said the unemployment rate for October is 6.98%. That's compared to about 6.67% in September. While it's much better than the FY20 rate, Mahesh Vyas of CMI has also pointed out that there's been a contraction in the labor participation rate. So we're roughly at about 40.6% versus 42.9% in October last year. And this is the first time that the labor participation rate has dropped below 40. If you look at the IHS market data for both the manufacturing as well as the services PMI, in both cases, they comment on how jobs is a very, very sticky issue, and that continues to be a weak point. A Kotak report has pointed out that almost 40% of urban jobs are in sectors that have been worst hit by this pandemic. That's construction, hospitality, travel. So that's the urban side of it. And on the rural side of it, Manrega has come in to help considerably, but even there, the demand far exceeds the supply. So when you look at the unemployment picture, how concerned are you at this point?
First, thank you very much to the Asia Society for inviting me to this. Unemployment, inflation, growth in a pandemic year is of not much consequence for what you first said, which is what is happening to the trend rate of growth. And so I'll speak more to that because, we can have numbers all over the place, whether employment, unemployment, inflation, etc. And, as a statistician, as well as an economist, you don't take outliers to make assessments of what's going on. But I do want to address the question that you've asked, and that's substantial, which is what is going to happen to the trend rate of growth, and let us say growth from next fiscal year onwards. And I think there, the situation in many ways is much better than it's ever been. So let me explain. And I'm not talking about a bounce back from this year. I'm talking about structural changes. India is one of the very few economies in the world that has taken the COVID crisis seriously, and the old adage, don't let a crisis go to waste. We have not let the crisis go to waste. The kind of economic reforms that have been introduced in India over the last 12 months, if you will, and it is starting from September of 2019, October 2019, so the last 13 months, are substantial. Whether it is on corporate tax cuts, which was the first thing to arrive, labor reforms, agricultural reforms, everything almost any economist was talking about, and I've been in this business a long, long time, along with other economists, that whatever we asked for basically has come to fruition. Now, the second consequence of what's the trend rate of growth, and let me just make it clear, I substantially disagree with that the trend rate of growth has dropped 2 percentage points. And because of what? What are the things that determine a rate of growth? Economic policies, economic reforms, this is structural. And now let's look at what's going to happen to oil prices in the future. Not too many, I don't know, the people who are making the forecast on the trend rate of growth, falling by 2 percentage points, have they looked at what's going to happen to oil prices? Are they going to fall? Are they going to rise? Are they going to stay the same? Very likely that the oil prices will not rise in any significant manner, and very likely that they will fall. We are one of the biggest beneficiaries of oil prices, falling and even stable. So, the other aspect that has happened and over the last couple of years And as you know, this is what I always have talked about, interest rates, real interest rates from a level of 3 to 4% real, which in my view caused, determined, affected both the trend rate of growth and the actual rate of growth from 8% that we had back in 2016 or thereabouts to 5% was a large part responsible, was determined by the extraordinarily high and the highest in the world policy rates. Those have now come to a very normal level, close to 0%. So are we saying, and I'm talking not you, but the forecast of those people who are saying 4.5%, that, oh, when you decrease your real interest rate by 300 basis points, your growth rate actually declines by 200 basis points. That's number one. Are you saying that when you have substantial economic reforms that every economist has been talking about for decades, that will have not only no consequence, but will help reduce the growth rate even further? This is an economics I frankly do not understand. But I'm hoping that the rest of the panelists can illustrate, but I just don't accept the conclusion, the premise, the analysis, and the basis for the forecast of a decline. So I think we are looking at my forecast, we're looking at bumper years ahead. And, you know, I've always talked about an 8% growth rate. And if you take for the fact that the world growth rate has declined, you also have to adjust that our growth rate has declined. We will very likely be the best performing economy for years to come over the next 5-6 years.
Well, I get the point that you're making, and I do want to discuss the trend growth rate in much more detail. But before I come to that, I do want to get your view. I know the data right now is noisy. I know you don't want to look at an outlier here and base your commentary on the economy on that, but it would still be helpful to get your view on the noisiness of this data. So maybe you can at least tell me, when you look at employment or unemployment or joblessness or many of the other parameters, what is it that you're watching closely to give you a sense of whether the recovery is sustainable or not in this economy?
Look, I look at the same numbers that you have and others do. Industrial production is back to normal. Electricity generation back to normal. Tax collection in terms of GST back to or very close to back to normal. All the indicators are suggesting that we are very rapidly approaching normality. Now, given that the big decline has been there, I do recognize that some of this is a natural bounce back. But listen, I don't see a single number, current number, and I'm not going to comment on the CMI unemployment numbers because I've commented on it a long time back, and we'll wait and see about unemployment. But inflation, let me just say briefly about inflation, that people look at the large numbers that we have observed. And this is something that I have commented on for a long time, that basically, in the US, they use the personal consumption deflator, as you know, for determining monetary policy in this, the largest economy in the world. And the rest of the world follows the US in many ways. And if you do a parallel adjustment or do a similar kind of calculation for inflation in India, you get it substantially lower by about 200 to 300 basis points. So I don't see inflation as problematical. I don't see growth as problematical. I just, as I said, there is a decline, there's a global pandemic. And one last point, on the pandemic, as you've noticed and everybody else is noticing, India's record over the last 2-3 months is quite spectacular on the pandemic, on the flattening of the curve. We don't have, and everybody's been proven wrong on the pandemic. So maybe I'll be proven wrong tomorrow. But the fact remains, and I've been looking at data for all the countries of the world, we have achieved a remarkable flattening. And I think credit has to be given to whoever has been responsible for the new policy, what I call the 3T policy of testing and tracing and treatment, that it's worked. So, I see that's the basis for my optimism. I think we've done a much better job over the last 2, 3 months in terms of confronting the COVID crisis. And I think substantial economic reforms are in place, and all the leading indicators are on track.
Okay, Dr. Bhalla, I think there is a debate out there on whether India has reduced testing, and therefore some of the numbers actually might be optically looking better, but they aren't. But I'll leave that debate outside because I don't think any of us can predict which way this pandemic will go and whether the second, third, or fourth wave will come and hit us tomorrow or next week. I'll come back to the data. We have only CMI jobs data. We don't have any other data to go by. And joblessness is a critical issue in this economy. You've not said anything about whatever data we have to work with. I still feel as if I'm trying to get a sense from you on whether we've done enough to generate jobs or to bring any degree of normalcy back to the job situation.
Well, let me just come to your jobs data. The CMI data in 2017 was showing that unemployment rate was 6.5%, 7%. So what is it about the CMI data today that suggests to you anything radically different? When at the peak of a recovery, they were saying 6.5%, 7% unemployment. So that's my comment on the unemployment.
A reduction in the labor participation, sir. That's what the data also shows. A 200 basis point reduction in the labor participation rate
comes out. The labor participation rate is a separate issue, Menaka, and you know full well that everywhere there is an analysis, and India has been an outlier in terms of labor force participation rate. I am actually working on that and would be happy to share the results with you when they come out. But let me assure you that the reading of the data on labor force participation rate, particularly of women, not in this pandemic year. Unfortunately, the women have suffered the most in this pandemic year. They are doing double duty. But even there, the education achievements, that as you know now, there are more women going to college than there are men. So I think this is the structural change that has happened in India that we need to account for when we talk about the labor force participation rate. But that's a separate issue. Believe me, we're not going to solve it on this seminar. But let me assure you that, and I will send you my paper once it's complete, a follow-up on the paper that I did for the Prime Minister's Council. And it's not discouraging at all. And I think it should be looked at in more detail, but people have done, in my view, a very knee-jerk analysis of the data. It is really, there is a structural change happening in India, and it is high time we all recognize it as a positive structural change.
All right, I'll stick with the near-term data for now. I'll come back to you on some of the issues that you've raised with regards to trend growth a little bit later. Mr. Narendran, I think I'd love your insights on both demand, how you view how households and consumers are behaving, because yours is a core industry. And so you will give us probably the best insight into that. Again, some data points there, right? Per capita income is expected to fall below $2,000 this year in India. It's likely to take all the way up to FY23 to just go back to FY20 levels. And if you adjust for inflation, it will take even longer than that. The household savings rate, financial savings, rose to 21.4% of the GDP in the first quarter of this fiscal versus 10% in the quarter before that. So clearly, households saving more, not wanting to spend. Of course, the lockdown was a big problem to be able to spend as well, but also precautionary savings, right? And then I'll come to one industrial indicator that's been interesting because we thought there was a recovery going on in auto. But here's what some data in auto suggests, and this is data compiled by SPI. They say in the May to September period, the retail to wholesale passenger vehicle sales percentage, which was 99.5% last year, has come down to 83.8% this year. Effectively, more sales wholesale, less sales retail. So the numbers there too can be a little bit, difficult to figure out. What is your assessment of demand in this economy?
Well, it surprised us positively, to be very honest. When we started this year, the financial year, we were in the middle of the pandemic, and we really didn't think things would bounce back so fast. First quarter was bad. If I look at steel as a surrogate of, overall economic activity, it was minus 20%. So it pretty much shrunk very significantly. So initially, we saw that the rural economy picked up faster, rural consumption picked up faster, probably because the monsoons were good. There was a lot of migrant labor going back to the rural economies. There was Manrega. So we saw June, July, August as good months in the rural economy. Anything that we sold in the rural economy was getting consumed. And even when we looked at our industries that we cater to, tractors were doing well, which is rural economy dependent. Motorcycles picked up before scooters. Normally, motorcycles sell more in rural economy than the scooters. So in many ways, we saw the rural economy picking up faster. The second thing which we saw by September or so is that the MSME sector started coming back because I think there's a lot of liquidity available. The money started reaching them. Government started paying a lot of dues, which was there for the MSME sector. So from that point of view, there was money flowing into the MSME sector. They started picking up. And auto is a big driver of sentiment. We saw, of course, started with tractors, motorcycles and scooters, and then passenger vehicles, and then finally commercial vehicles. But in commercial vehicles, it was more the LCVs and medium-sized commercial vehicles, and finally the HCVs. So step by step, we are seeing each of the consuming sectors pick up. In addition, wherever the government was spending, like oil and gas pipelines, water pipelines, railways, etc., there was a lot of activity. And because of what was happening in the pandemic, we saw people were spending online more. So you saw a lot of e-commerce firms building supply chains, so a lot of investments in supply chains, warehousing, so on and so forth. So in many ways, pretty much most parts of the economy has started coming back faster than we thought. Everyone said after the festivals it will drop. So far, maybe passenger cars have dropped a bit, but commercial vehicles go on from strength to strength. In addition, if you look at companies like JCB who supply material handling equipment, and they track equipment activity because they have telemetrics on that. And they were saying that a lot of activity is in semi-urban and rural economy because of the projects being taken. So the focus on infrastructure, the focus on the rural economy, I think has shown us that the rural economy is bounced back faster, urban economy is following. I think manufacturing has bounced back faster than services, which is good from a steel point of view because manufacturing is more steel intensive than services are. In construction, again, for the last 2-3 months, activity was low because there was not much labor back on sites. Now we see a lot of labor back on sites. So if I look at construction, it's picking up. Residential is picked up even faster than we thought. And commercial infrastructure is still a bit weak, but industrial infrastructure is strong. So most parts of the economy, from our point of view, seem to be bouncing back quite fast.
Mr. Narendran, one of the things we've been trying to discern from the data is how much of this is sustainable. Is there any way, gauging from your order flow, you can tell us whether you think that this is demand that's just a burst in terms of the big contraction that we saw in the first few months? Or do you believe that there is some degree of sustainability to this demand over the next 6, 8, 10 months?
So I think with every month, we are growing in confidence that this is sustainable. I think what we said a couple of months back was it looks sustainable, but it needs to be nurtured. We shouldn't take our eye off the ball. We need to make sure that the liquidity continues to be strong. We need to make sure that the fiscal interventions continue. And I think with the government's announcements, as well as the reforms that Dr. Bhalla talked about, there's a lot more positivity coming into it. The other thing which helps is for commodity products. I mean, if you look at steel, for instance, and steel prices go up, people also prepone purchases. When it's going down, they postpone purchases. So that's also helping. So overall, we are seeing that, things are pretty strong, at least till January or February. And normally that's when activity again picks up in the economy. For us, we normally see January to June as the best months every year. And so we're going into that period on a reasonably high note. So I think it's sustainable unless this pandemic really comes back and bites us hard in the next few weeks and there are more lockdowns. I think that's always the derailer. Globally, we've seen this happen in Europe. It's not yet impacted business activity in Europe yet, but it's quite significant. So if something similar happens here and we have lockdowns, even if not a national lockdown, multiple lockdowns at the local level, at the state level, that can be disruptive for supply chains. That can derail things, but otherwise, I think, things have been better. And one point which, impacts us significantly as an industry is that China has bounced back very well. China is now producing and selling 2.5 million cars a month, which is what they were doing earlier. And the Chinese economy is bounced back very fast. And that certainly allowed us options to export if the domestic market is a bit weak, and which is what we did in June and July and August. So in many ways, international markets have also supported the recovery much more than we thought.
Okay, a very quick short follow-up before I move to Ridham, and that is that, do you see the return in sort of confidence and business activity at par with this, same time last year? Has it exceeded that? Is it still below that? Can you qualify that for us?
For us, it's better than last year this time, because last year this time things were slowing down. If you remember last year, yes, from April to September or October, things were really slowing down. Then there were a number of steps taken by the government and things started picking up till March, till the pandemic hit us. So we were on the down curve at this time, starting to pick up, whereas now we are already on the up curve. So in many ways, October, November will be better than last year. Maybe December, Jan will be similar to last year.
Okay, fair enough. Ridham, the data, again, very confounding when it comes to, and I know you look at earnings very, very closely, so I'm going to put that to you. And then, of course, you can respond not just on the earnings bit, but across the board, all the data points that you're looking at as important measures of whether this is a sustainable recovery or not. Corporate results have been good. Growth in corporate GVA of about 3,600 listed companies is at about 22% year on year for the second quarter, the quarter that just got done. This is according to SBI data. But there is a dichotomy between how the large companies are doing and how the smaller companies, especially in the more informal sectors, have been doing. So I'll just bring up one way of looking at it. You might agree or disagree. If you look at the listed company space, though revenue is down roughly 10%, net profit is up between 20 to 30%, depending on which sector you look at. Now, that suggests that companies have cut back substantially on costs, found all the synergies they could, efficiencies, etc. And while that's good for the large listed companies, it may not spell very good news for the medium and small size suppliers to these companies. So corporate India seems to be telling two different stories at this time. Would you agree?
Okay, so Menaka, let me start first by saying that, over the past 20 years, there have been many times I have disagreed with Surjit. But today, every single word, I agree. So first of all, I want everyone to assume that I said that. What he said is what I just said. So I will not repeat anything of what he said. The second is you kept on pushing him on jobs data. So let me add there that, jobs is a lagging indicator of economic activity. It doesn't lead economic activity. Jobs and credit, these are not indicators that you should look at when you're assessing the economy because they come with a lag. Credit, by my experience on India, lags by about 6 to 9 months, and jobs by anywhere between 12 to 18 months. You see, firms don't hire ahead of an economic cycle. They hire after they see a recovery in demand. Okay, so
I'm not disputing that at all. I'm talking different data points here, not just one data point.
No, don't look at jobs data because that's not going to tell you where the economy is. 12 months from now, If the jobs data is not showing a recovery and the economy has shown a recovery, then we can start writing skeptical notes about the economy. Today, the jobs data is not relevant. Now, on your other point on high frequency data, the fun is about to start. Morgan Stanley, right from May, has been around the -5% mark for the economy this year. In terms of GDP growth, the consensus was at -12, now it's at -10. So just wait, the fun is about to start. We're going to get some really outstanding data if we are right. And I believe we are right. I think everybody has got this wrong. What they've assumed is that there has been a permanent loss of demand between April and July. That's not happened. In fact, for a while I was assuming that a lot of the loss of demand in services is permanent. But now I'm learning that even that is not permanent. And I'll give you an example. The vacation that people didn't take in the last 6 months, they're taking it now. And they're going to take another vacation in December. So they are actually fulfilling the lost demand in services also. So, to the extent that all these estimates out there, when I try to marry it with Morgan Stanley's estimate, the only conclusion I arrive at is that people have assumed that the demand, the economic shutdown that we had between April and July was a permanent loss. It's not. And that is why it explains the gap between retail and wholesale sales that you gave for passenger cars. That's the gap explained by inventory refill. You see, when you get such a unusual situation, inventory drawdown happens. Now, nobody operates with zero inventory. We're not Japan. Everybody has pipeline. And in India, you need to actually have more inventory. And, Narendran will agree with that because there are inherent inefficiencies in our transportation system. That inventory refill is happening right now. So this initial data revival that you've seen is only inventory. A lot of it is yet to translate into actual demand, which will come now because people are back. I'll just give a personal anecdote. I was in Lonavala over the weekend, and there was a 1-hour traffic jam at Lonavala because it seemed like the whole of Mumbai was there trying to, grab their lost vacation. Okay, now coming to the point on company data. So clearly, the corporate sector has reacted marvelously well to the pandemic. I would have thought that the corporate sector would have been a bit reticent, would have taken very defensive measures because of what was happening. Rather, the companies that, on the aggregate, and I'm not distinguishing here between small and large, have essentially used the period of the pandemic when the lockdown was effective to restructure, to raise capital, to undertake acquisitions, to do mergers. A lot of these indicators are at multi-quarter highs. So they were not actually sitting quietly doing nothing. Our bankers have been very busy over the past few months doing all of this. That is basically what it tells me is that as we come out of this lockdown situation, and I agree with Narendran that the risk that COVID comes back is an active one. We should not underestimate that. We're seeing some signs of that in a few scattered places, and therefore we're not done with COVID. But assuming that COVID doesn't make a national resurgence, then I think you will see all this corporate activity feed into growth as things settle down. Now on the earnings data, well, clearly smaller firms hurt more when a slowdown happens. And that's been happening since 2017. Since the economy slowed down, smaller firms hurt a lot more because they have more operating leverage and more financial leverage. So that they have hurt during the pandemic is no surprise. Larger firms tend to do a whole lot better. And larger firms tend to gain market share. They have better balance sheets. They can actually do a lot of things that smaller firms can't. But if we are right, and I am of the belief that the economy is going back to its old trend growth, and I'm really not sure why somebody is telling me that trend growth is going down 200 basis points. If anything, I think we should be toying with the idea that trend growth is actually improving in India. It's not actually getting worse. And I think that, after operating below trend growth for almost a decade now, we are now seeing the signs of going back to trend growth. Smaller firms will make a ferocious comeback. All they need is the economy at trend growth, and they will outgrow the larger firms. So, in fact, from a stock market perspective, I know you have not asked that question. We've seen a very high concentration of profits and market performance. So, market cap and profit concentration, which is the share of, say, the Sensex companies in total market cap, is now at about 52%. It's a number we have not seen since 2009. The share of profits is even slightly higher. I think both have peaked, which is the share of this both profits as well as market cap for these large companies will go down as we come out of this economic downturn, and I think India starts reverting to trendline growth. I think people are underestimating the changes that we have seen since last September. It's pre-pandemic actually. We didn't start making these changes only during the pandemic. And I know you had this initial question, which you've not yet asked anyone about the government response. I think it's been stellar. The fact is that we had limited.
Don't answer it now. One second.
Okay,
Don't answer.
okay,
I'll come to that in just a bit. But I want to cross question you a little bit,
yeah, sure.
Which is not to suggest that the economy is going to do badly. That's not of the economy. We're kissing 13,000 on the Nifty now. I'm not sure that's necessarily the best indicator. But nonetheless, you're saying that concentration is about to peak. But there are many others who actually believe that this narrowing of the corporate pyramid, the fact that in so many sectors now we have fewer players, bigger players, the fact that we've seen the mid-size, small-size business community get decimated from the time of demonetization, then GST, which was very difficult for them because of their viability was questioned. Now this pandemic, that we probably will never see the mid-size, small-size business sector come back to health anytime soon.
See, Menaka, I think Surjit mentioned this in passing about global growth and its importance to India. So we don't operate in a vacuum. We are the sixth largest or fifth largest economy in the world now, give or take 1.1 rank here and there. And certainly next year we will be back to top 5. We're not living in a cocoon. If the global economy doesn't do well, our growth is not going to do well. And a lot of people think that the growth that we had between 2004 and 2008 was all India's doing. Well, a large part of it was because global growth averaged 5% in those 4 years. And that's staggering. We've not seen that type of growth before and after. So if global growth is going to do well, which is what the Morgan Stanley base case view is, and the reason for that view is, and I'll say it very briefly, is that we've seen unprecedented stimulus. The reaction of governments and central bank to the pandemic was almost panic. And they have applied so much of synchronized stimulus from the US to Japan. So cross geographies and between the government and the central banks, all that stimulus is waiting to pour into the economy. It has first gone into the asset markets, which is why the bid on assets, whether it's gold or whether it's share prices and now even property in several countries, and hopefully even in India, property prices will start seeing a recovery down the line. It will then filter into the economy. And given the vaccine news that's coming out, the chances are that 2021 will be a stellar year for global growth, and probably even 2022. Now, if you get that outcome, then India's growth will be very well supported, because we've not been short of policy either, which is very unlike 04-08. 04-08, India does not have its own policy agenda. This time, it seems like we're already ahead of the curve, starting with the corporate tax rate cut in September to the PLI schemes, most recently labor reforms, agri reforms. We're not even talking about the potency of agri, because that's going to lift the bottom of the pyramid. All this is great news for smaller firms. I think this is a very good period that's coming back for smaller firms, which last saw such broad-based growth way back in the period between 04 and 07. So I don't blame people if they have forgotten that smaller firms can do well. Since the global financial crisis, it's only been large firms. India has had suboptimal, sub-trend growth for bulk of this period. And that, I think, is set to change. So it's premised on my optimism, or I'd say Morgan Stanley's optimism on global growth and India's growth. And if that we are right about it, then I think a lot of these investors and market participants are in for a big surprise.
All right. I know you said that credit growth is a lagging indicator, but I do have a question, and I'm going to rope in Sunil to answer my question. All the data suggests that credit growth has been abysmal this year, and not surprisingly at all. But equally, on the surprising end, on the good news end, we are seeing that corporate balance sheets have been a lot more resilient. Now, again, maybe you might blame me for looking at the larger companies. But there was a CRISIL report that was out recently which suggested that 99% of the large companies that are eligible for any kind of loan restructuring don't intend to take that loan restructuring scheme that the RBI has introduced under its pandemic measures. So, Sunil, it's a lagging indicator, but how lagging is this indicator? How long do you think it will take for credit growth to pick up, for therefore then substantially investment to pick up? And I'll come back to the first point that I made. Both those are critical for jobs growth as well.
Thank you, Menaka. I wasn't scheduled to be a panelist, but I'll respond to your question. So, I'll sort of go back a little bit, because this whole aspect of credit growth is being questioned for a number of years. And this is post 2015 when the AQR started, and we had this whole velocity of recognition of impaired assets. I think over the last 5 odd years, I would say that this is probably one of the defining moments of Indian banking, that there has been a deep introspection in terms of what went wrong. And obviously, some of the loose credit policies, we didn't have adequate risk management practices right across the banking system, public sector and private sector banks. And everybody, because there was so much of liquidity, everybody was really building their own balance sheet. So hence there was a race for building your asset size. And I think this whole concept is being relooked at. The second piece is that for the first time, the largest component of the Indian banking industry, which is the public sector banks, are looking at a risk-adjusted return on capital. That concept didn't exist. So they were basically doing almost venture capital funding for risky projects, and particularly the large infrastructure projects which consumed a lot of credit. That has changed. And this aspect of redefining as to whom you need to lend to, on what terms, is now coming to a much more rational aspects of risk management and return on capital. And one of the important impact on large borrowers, some of whom sort of went belly under, is that movement of those assets from people who were not able to service that is now sort of taking place because of the unfortunate IBC sort of situation. Now this may get a little bit more delayed, but I think that movement has already started, whether it goes to the IBC process or a sale process. So I think as these assets move into more secure, the impaired assets move into more secure promoters or corporations or investors, you will have credit flow back into the system. And as the large corporates start getting back into motion, the smaller the MSCs will obviously sort of piggyback off that growth that is going to happen, and the credit flows will go right into the system itself, which had slowed down for various reasons. Because if the large corporates were not doing well, it obviously impacted the whole supply chain itself. So this change, unfortunately, the pandemic came in between, that this sort of change got extended. But I would say that there are definite signs of many of the borrowers did not go for the restructuring. So you will find that they will probably be back on a much better, in a more efficient way, where the banks will feel far more comfortable lending to them. The whole aspect of some of the larger corporates deleveraging, I think that's a good sign. If we looked at the entire group aggregated leverage of some of these large names, it was absolutely nuts. And why this was not brought at, right at the center of the review of all these large corporate credits that we were sort of lending to, I think that is sort of water under the bridge. But now the appropriate amount of leverage is absolutely critical. Anything that you go beyond that number of 2.5 to 3 in some of the manufacturing companies will put us back into a difficult position. Euphoria comes back, and then of course all the lenders sort of go back into the lending mode, and we have to be far more careful. Supervision and regulatory oversight, that has definitely become much more acute. People cannot go the way, people cannot just sort of lend the way they were lending in the past. What aspect that we've got to look at is corporate governance. from both from the bank's point of view and the borrower's perspective. This is really the kind of aspects of change that will evolve over a period of time. We all have to be very, very careful about, do we really enforce governance in both in spirit and in letter of the word? It's not just from the letter, but really on the spirit. If that happens, I think credit flows will be back, because this is ultimately, when we talk about inadequate credit outflows, banks are holding back, becoming risk averse. I sometimes wonder, what are people talking about? It is the taxpayers' money. You cannot go completely sort of go out there and lend if it doesn't make any sense. And I would still say that we've got to be far more rational, and the credit growth will, if the projects become more bankable, I am very certain that the credit growth will go back to, in their early teens.
All right. Okay. So I'll come to my second point that I wanted to make, and I'm going to put this question broadly to all four of you. And that is this: in the short to medium term, let me put it that way, we've had 3 iterations of the Atmanirbhar Bharat scheme, by the finance minister. Too detailed for me to sort of try and list out everything that she's announced. But the jury on that has been mixed. Many people believe that it's been very incremental or meager, and yet others believe that it's been measured and that she's waiting for a proper restart of the economy before she sort of brings out the big guns. So that's one way of looking at the short to medium term measures. The medium to long term measures, I think Dr. Bhalla spoke of earlier on. We saw a corporate tax rate cut last year. We've seen reform in both labor and the farm spaces this year. But the criticism on that is that we find it difficult as a country to follow through on such reform. For instance, look at the implementation issues that we faced with GST in the last couple of years. They haven't been able to allow for that tax to fructify into what we had hoped it would be, which is effectively a GDP booster, right? We face teething trouble with IBC as well. So, Dr. Bhalla, let me come to you. Do you think the government has done enough, both buckets, the short to medium, which is equally important, and the medium to long?
Look, I very honestly, and it's a good question, I would say that I have been very positively surprised by the government in this crisis here. No one expected them to do so, and the record is nothing short of spectacular. Now let me address, so as far as the government response has been, both from the monetary side, that is the RBI, and the central government side in terms of reforms and fiscal policy, I think has just been absolutely remarkable on a worldwide basis, not just on an Indian basis. Now coming to that, the fault, dear Brutus, is in our implementation. I wonder how many people have looked at when we had the big reforms in 91. We grew at about 7% for 3 years, from about 5% before. And then we came back to 5%. So, where's this record? As an economist, I'm always looking for benchmarks. I'm always looking for the counterfactual. So where is this counterfactual? The labor reforms have just been announced. The whole APMC Act, the agricultural reforms have just been announced. So let us just be patient. And patient, I don't mean wait 10 years. I don't mean wait 5 years. I'm just saying wait 6 months before we start saying that there's some problem with the implementation. So really, I come back to, and I'm glad that Ridham and I are on the same side. Actually, we've often been on the same side. He just saying that he's been opposed, but and it's been 20 years or so that we've been discussing. But really, I know I'm at the IMF. I know I'm a government representative. But believe me, I would be saying exactly the same thing if I were not. This is, and in a comparative sense, because at the IMF, you get to study all the economies of the world, etc. And the reforms, just look at it. You can Google how many countries have brought in major reforms. None, or maybe 2 or 3. Greece has done a good job. So it is what comparative.
Forgive me for interrupting you. Dr. Bhalla, forgive me for interrupting you. The reforms spell good news from a medium to long-term point of view. But don't you think the government's response from a short to medium-term point of view has been found somewhat lacking? You could argue that we don't necessarily have the fiscal capacity to do more. And so therefore, given the space, they've done the right things by targeting some of these measures. But you could also argue, as many other economists have, that this was the time to throw a little bit of the caution to the wind. And spend more than you're comfortable with, because that's what would bring the economy back far more firmly and strongly.
Now, if I look at the short-term experts you've got on this show, and I'm more of a macroeconomist, more long-term, but look at the short-term. Each one of those experts have said on your show that, listen, the record on the short-term, we heard from the construction industry, we heard from the steel industry, we heard from Ridham, we heard from Sunil Mehta. Where is the short? So now, are we talking short-term, the first 3 months or the first 4 months? Or are we talking short-term, 6 months to 9 months? And, we will, to use Ridham's phrase, the fun is yet to start, or has started and we're not seeing it because we are blinded by our preconceptions or by our biases or by our ideology, you name it. But the fact remains, just look at the numbers. Every number is coming out positive, is coming out spades. And, the beauty about Indians, etc., we are never satisfied. That's fantastic. Okay? We want better. The whole world wants better. Absolutely. So can we do better? Yes. In theory, we can always do better. In expectations, we can always do better. But let's look at the reality, and let's look at the hand we were dealt with. Then look at it. So the response, and do not underestimate, really, my plea is, do not underestimate the structural changes that have come about over the last 12 months. This is big time reforms. And you will see the consequence of it very soon. You'll begin to see the consequence of it very soon. And it will be very long lasting. Menaka, all the economists, all of them, just look at what they've been asking for. Just do me a favor, look at all your favorite economists, all your favorite critical economists. Just look, do the reading, you've done it, okay? And see what they were asking for over the last 10 years, 15 years, 20 years, and see what this government has done in 1 year in terms of delivering on the ask. The implementation will come by and by as it is coming right now. But just do that exercise. It'll be a most revealing exercise for you. Take down every critic economist that you respect and and just look at the record. The web space is there. You can easily check who said what when, and just post it to them and post it to me and see whether things have answered or not.
Well, okay, I'm not disagreeing with you. Implementation, though, and it's not about this particular government or another, I think has broadly always been, a challenge in this country. But I won't dwell on that further. Ridham, do you think we could have done more in the short to medium term?
See, Menaka, the proof of the pudding is in eating it.
Yeah, but nobody knew the bounce back would be like that. So did we do the right thing by waiting for this?
No. So if the economy has bounced back, and if we are opining that the government is responsible for the economy, then the government has done a good job, right? I mean, we can't keep harping that they didn't do enough. It seems like they've done more than enough. If the data is an indicator, of course, you can come back and say, oh, no, things are going to be worse in 6 months. We'll see then. So as far as the short term, because you asked two questions, right? Medium term and short term, right? So as far as the short
Ridham, sorry, okay, my apologies for interrupting you, but let me just put one data point to you as the argument, and this isn't about this particular government or another, but one of the features we've seen over the last several years or in the last 2 or 3 years has been government dues to industry, right? And this has been a nagging feature. So many companies have been crying about it, not necessarily Tata Steel, but many, many others. Now, yes, we've devised schemes, rescue and relief schemes for medium and small sized businesses as part of the Atmanirbhar Bharat packages. But let me tell you that as of March this year, the data suggests that 14 lakh crores was out, 1.4 lakh crores was outstanding to the MSME sector in terms of payments. And very little of that has actually even reached them at this point in time. I don't have the last minute data on this, but I'm just using that to contrast with the fact that when we can't even pay our dues on time, why are we talking about having done the right things in our rescue packages?
See, Menka, we can't take individual data points and then create a narrative out of it. So I think we have to sit back and say, okay, the government had to do something, and the evidence of whether they did enough or not was going to be what the economy did.
Okay.
And I think, yeah, so the economy has done fine. It has surprised everybody on the upside, save for a few optimistic souls like me. And now everybody is saying, okay, now the growth is going to be slightly better. And as I said, now they're going to actually come around in 3 months and say it's going to be even better. But we'll come to that in 3 months from now. So I think as far as short-term action is concerned, I think enough was done. Otherwise, the economy would not have recovered. And we would be still struggling. So I think the evidence...
There was always going to be a natural recovery, wasn't there?
Why was the consensus so bearish then? No,
so you're saying maybe people were more pessimistic than they ought to be.
I don't watch much television, but
I don't either.
Exactly, because we have discussed this in the past. But every television channel was telling me how grim the economy is. They were telling me the rural, the migrant labor ain't coming back. Narendra just said that his construction sites are now full, right? A lot of companies have said that all the labor is back, 99% of the labor is back. And, in May, people were saying, oh my God, what a bad handling of the crisis. These guys are never going to come back. All those narratives have fallen flat. Let's accept that the economy is doing well right now, and some of that credit should go to the government. Okay. And therefore, we should not now start again going back to whether they did enough or not for the short run. We'll come back to the medium-term point. And this is an ongoing thing. Like, the government's job, neither does your job nor my job end, right? It continues tomorrow, and maybe the economy will ask them to do further in another month or two. Maybe it'll probably not require more action. And we'll see on that day when the government reacts or it doesn't react. I personally think that by not consuming too much fiscal space, I think they've preserved India's very hard-earned macro stability. I think people have forgotten what happened in 2013 because of extremely high inflation and deeply negative real rates. We had a major currency shock. We've come a long way from there. Fiscal deficit had gone haywire. We've conserved our macro stability and yet not let our economy suffer. So that is a very fine balancing act, and it seems to have been done well thus far. So I think the short and medium term actions are, par for the course. The long term actions, I think I'm not going to add because I think Surjit has already commented on it. But there's one thing that you asked about, which I think is pertinent, which is about execution. Is that we've seen execution falter in areas like GST. You may say IBC also went through its pushes and pulls, and I think this is very natural for a democratic country like India, which is things will get challenged. There will be a lot of opinion on GST. The comment that I have made to a lot of foreign investors is, let's try and get the 50 states in the USA give up their power to tax forever, right? And remember, states in the US collect income tax as well. Indian states don't. So they have still got another stream of revenue. But let's try and get them to give up that power forever. And let's see how many years it takes for Washington to achieve that. And of course, this is a hypothetical question because that ain't happening. But I think in the context, and if I recall correctly, was that let's get GST out of the door because we can keep negotiating this forever and it will take another 10 years. So I don't think there was anything but an inefficient act that got passed through because it had to be done, and then we'll work on it and get it improving over time. And I think 2020 GST is better than 2017 GST, and 2023 GST will be better than 2017 GST or 2020 GST. So I think we're improving on it. Execution is certainly a challenge on all areas for all governments across the world. There's nothing unique about it for the Indian government, but I think we should not take away from the fact that in the last 12 months we have had unprecedented policy, which nobody expected. I didn't for sure. I was not expecting so much from this government that they have packed in the last 12 months, and we're still getting our hands around it and trying to understand the long-term implications. And as I said earlier, we have to start toying with the idea that we have lifted our long-term potential growth, which had dropped post-global financial crisis, and the fact that we may actually now also start reverting GDP growth to trend line. I think these are very serious debates that need to happen.
All right. Well, the consensus, at least on this panel, seems to be that we might not just return to trend growth, but actually even exceed it, as Dr. Bhalla and you have put it. So let me rephrase my question then to Mr. Narendran. As the last question I'll ask you, and then I'll take a couple of quick audience questions for all three of you. If you had a wish list that you think that the government should be most attentive to at this point in time, given that the corporate tax rate cut has been done, given that there has now been new flexibility introduced in the labor codes, given that the farm laws suggest, and some of this reform has been happening over a decade now, but at least this one big move this year might do things to ease up the agri space and boost growth there considerably. What do you think is left for the government to do, Mr. Narendran, that you would like them to attend to on a priority basis?
I think if the government spends on infrastructure as it is promising to do, I think we are there, because it's a big force multiplier, for multiple industries. It also helps us bring down the cost outside of our factory gates, which has been a concern in India, because we keep talking of competitiveness. Industry can drive competitiveness within the factory gates, but outside of factory gates, our costs are much higher than it is overseas. So to me, infrastructure addresses demand, addresses joblessness that you said, and also addresses cost competitiveness. So for me, that's number one on the list. The government has announced a lot of plans. I think we need to see the money on the ground, which is starting to happen. We need to see more of it.
Okay, but you don't think that we've been slow on that front as well? Again, I might be pushing back, and I might sound like the cynical journalist here, but nonetheless, I do want to ask you that question. For instance, let me tell you, I think there was a rescue fund for real estate that was crafted late last year, and it's made marginal headway so far. Now, sure, it's been a pandemic year, and you might argue that, but even in the first 6 months before the pandemic, it had made only marginal headway. The same is the case with infrastructure.
Yeah, I agree. I agree that on infrastructure, the spending has been lower than the promise. But I can see that over the last few months, it's starting to pick up. Certainly, it's happening in the rural, as far as rural infrastructure is concerned. And I think, I hope that in the second half of the year, we'll see more investments in urban infrastructure as well. And I think a lot of what's happening in terms of airports and metro railways and things like that are good. That's positive. From an infrastructure point of view. So we're seeing things happen. Of course, as industry, we always want more. And I think if you look at what is the promise and what is the delivery, there is a gap, but I think we're heading in the right direction.
All right, let me take a few questions from the audience. Unfortunately, this person has not put their name in, but they've asked a question, and I think, Ridham, you might be able to answer it best. For global growth to get percolated in India, does India have enough avenues to invite foreign investment?
So I think, Menaka, there's been a dramatic change in the attitude over the past 12 months. And it has coincided with the Morgan Stanley view that we are moving away from a bipolar world to a multipolar world. So this backdrop is very important. Very simplistically put, we were for the last 2 decades and change in a bipolar world where China concentrated all the production and US was the consuming country. That has changed over the past 4-5 years. And the likelihood is that now we will see new areas of consumption emerge, but more importantly, new areas of production. Now, it needed a policy response from India because companies were looking to diversify away from China, and they got that. They got that first with that tax incentive last year, and they got it further with the labor law reforms as well as the production-linked incentive schemes. And when I talk to multinational companies, they're very excited. a lot of them actually don't see viable options outside India in other parts of Asia. And if you talk to them, and you must invite them on your shows, companies that sit in Taiwan, that sit in Korea, they're all talking India, India, India right now. People are going to be surprised how much investments will come to India over the next few years because of these changes and because of the backdrop that we have globally.
Okay. We have one more question that's come in, and I can put this both to Dr. Bhalla and Mr. Narendran. If the COVID situation is contained effectively and private sector enters growth period, will it absorb the job losses from small firms? And then there is an additional part to that question. Will there be a trend of M&As that we foresee? Dr. Bhalla, you want to go first on this?
This COVID thing keeps coming up. Maybe there's a second wave, maybe there's a third wave. And those are all very legitimate concerns. We need to balance that pessimism with the fact that unlike 6 months ago, there are now 3 vaccines which will be in the market in a month. Now, and don't go by, in my view, don't go by that we need 7.5 billion doses for the 7.5 billion population in the world. You really need it for people like me above a certain age, especially men. They are more vulnerable than women. And, I think the vaccine production, and obviously those who have comorbidities. And I think the world has had enough time to plan for it, that even if there is a second wave or third wave, that the vaccine situation will moderate. So let's not get into, in my view, we should plan for a second wave, third wave, but we've got the vaccine, we did not have that before. So that's my first point. That's an additional point on us getting back to normal across, in terms of employment, MSMEs, just look back to 2016, 2017, and 2018 in particular, when the MSC model exploded, or when it imploded rather. And now look at what is happening. The delta, I've always emphasized in whatever conversation I have, always look at the delta, the change. The level is not important. GDP growth is the change. It's not the level. And really, I'm forced to repeat, but I do think that the preconditions for India getting back to 8% very soon are there. And at the risk of being too optimistic or being proven wrong, I really, if you ask me as an objective analyst, what are the problems that you see? I'm afraid, maybe because my imagination is limited, I do not. I think the problems are to do with global competition. The problems are to do with the rise of China, the balancing act with the US as well as the rest of the developed world. But that's more competition. And competition means increased productivity, increased growth. So I'm also not that pessimistic on world growth either. And if world growth also bounces back, and mind you, the advanced countries, for them to go from 1.5% to 2% is a big leap forward. So I'm not saying that the advanced countries will start growing at 3%, 4%, but they will also improve. So the delta around the world on a structural basis, take out the pandemic here, compared to 2019 and 2021 onwards, the delta is very positive. So let's sit back and see what problems remain in India. I think the point about infrastructure investment is very, very positive, or very, very necessary. That's where the multiplier is there. That's where the need is there. And I think on the health side, as well as social indicators like education, things have already been improving. We need to improve the quality of education. Absolutely the case. But the delta is huge, really unprecedented in my view. The 2008 crisis and the delta afterwards is much smaller than the delta that's going to be this year for the world as a whole.
Okay, I won't put that jobs question to you, Mr. Narendran. I'll put one last question to you, which is sort of also summarizes some of the points made by the audience. But broadly speaking, do you see us get back to an 8% kind of growth level at all? And in this conversation that we've had today, we haven't discussed, India's import or export policy so far. We haven't discussed where that might be lacking. We haven't discussed this new, some might call it protectionist move, towards import curbs of a variety of different kinds, and whether that will effectively, over a period of time, hurt exports and hurt India's ability to participate in the global supply chain. Especially many of those are changing right now. So keeping that in mind, can you give me a quick wrap-up answer on whether you think we are well poised at this point in time to reach the 8% that Dr. Surjit Bhalla is talking about?
So obviously, in the short term, there's going to be a bounce back. Whatever is the amount that we shrunk, we will get that back. But in the long term, I think 6 to 8% is possible. I think the focus on infrastructure, the policy changes that have been made, the increasing interest in India from an investment point of view, and I think this time the growth is going to happen more in tier 2, tier 3 cities, a bit more in the rural economy. So it's going to be more balanced than just a few cities and activities around the urban centers. So I'm more positive. It's not going to happen overnight, but I think we are headed in the right direction.
All right, gentlemen, I'm going to leave it there. We're at the end of our time. I started this discussion by suggesting that there are some forecasts that trend growth might come down to 4.5%. But my three panelists believe quite the opposite and expect that, in fact, we're at the beginning of much better trend growth than we had anticipated. So I'll leave it on that positive note. Thank you to all three of you, and thank you to Asia Society.
Thank you. Thank you, Menaka.
Thank you. Thank you very much.
Before we all sign off, I just wanted to say thank you on behalf of the Asia Society to all our panelists and, of course, Menaka. Menaka tried very hard this evening to figure out from the three panelists in terms of what else can this government do in the short term. And I think the positivity with which all the three panelists responded, that a lot of is already in motion and this will sort of carry us through, was very nice. It was a nice change to hear this kind of optimism and positivity. We certainly needed to remove the negative sentiment that has sort of percolated and has been around there for such a long time. There is obviously questions that she's mentioned that left, we haven't really didn't have time to take a deeper dive at in terms of our trade policy. What about protection? How do we sort of react to creating a much more sustainable growth from here so that we can sort of not have the kind of possible volatility? I think the real takeaway from me is that, one, from the economist perspective of how comfortable they are with the trend line. The second is, of course, from a practitioner's perspective, which is really where there is kind of many more elements that are visible of good sustainable growth coming from the steel industry, which is, as Narendran mentioned, a surrogate of the economy itself. We conclude this debate with that positive optimism. Thank you all for being such wonderful participants this evening, and to all our participants who have joined for the questions. And Menaka, thank you for keeping this as a lively session.
Thank you, Sunil. There was one more question I didn't put to Ridham if he wants to answer it. Somebody asked you for a price target on the Titan stock, Ridham.
That's, I think I read.
No, don't answer it.
No, I read the question. It's about valuations, and of course there are some valuations which are looking a little bit heady. And that's always the case with markets. And there are other places where valuations are looking very, very attractive. So you get that dispersion all the time.
We'll leave it there. Thank you so much. Thanks to everybody.